Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, April 9th, 2025. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is the U.S. heading into another emerging market style crisis that forces the Fed to supply QE? Our answers are the nominal 30-year Treasury yield briefly pierced 5% for the first time since November 2023, as investors question the haven status of U.S. sovereign debt, sending the dollar lower for a second day and fueling fears that growing market volatility and forced deleveraging may trigger a systemic break in financial plumbing. Explanations for the sell-off range for foreign investor liquidation of U.S. debt to hedge funds unwinding over $1 trillion in basis trades to a broader revaluation of U.S. debt by global reserve managers. That it is likely all three is contributing to fresh speculation across global Wall Street that the Fed may need to step in and stabilize the bond market. Perversely, investors should welcome Treasury market dysfunction like this because it is the fastest route to the Fed supplying the QE asset markets require to curtail the worst of the global debt refinancing air pocket we've been warning about since last fall. Recall the Fed intervened in the Treasury market to the tune of $1.6 trillion in March 2020 during the COVID crisis. Indeed, this is the third such emerging market style financial crisis the U.S. has experienced in 5 years, going back to obviously the regional banking crisis and COVID, and now. You can actually make the case that summer of 2023 was a little bit of a taste of that, but obviously the Fed pivot toned that down. We view the current meltdown in the Treasury market as part and parcel of the fourth turning poly crisis that we've been preparing 42 Macro clients for since the summer of 2023, when we first debuted our Investing During the Fourth Turning Regime presentation. One of the key takeaways from the presentation is our structural bearish bias on Treasury bonds and expectation that the U.S. would have a cascading series of EM-style financial crises that require greater and greater monetary debasement and financial repression by the Fed to calm Treasury market dysfunction. We put this deeply researched view into action when we pivoted our systematic KISS portfolio construction process permanently out of Treasuries and into gold last fall. Ultimately, the Fed will be forced to go to unprecedented lengths to plug the growing, geopolitically driven supply-demand imbalance in the Treasury bond market once the world deems the U.S. to be in a fiscal crisis, an outcome we still anticipate by 2030. I get chills when I think about the impact of such a great monetary inflation would have on the poorest members of our society, i.e. the people that I grew up with. That is why I'm so passionate about helping both sophisticated investors and ordinary people prepare for these global macro risks. Transitioning to our 42 Macro dashboard, as always, we'll wrap up the question from our community. This one's regarding KISS. It says, hi all, I'm a new subscriber and will be leveraging KISS portfolio going forward. Thank you for joining us. We appreciate you. As I close my position in my current accounts, do you recommend dollar cost averaging in and out of the new positions? Appreciate the support. So again, like I said, thank you for joining us. Appreciate you. KISS is doing a masterful job of keeping our clients on the right side of market risk, just as it has done, for the past 2+ years now. We launched KISS in January of 2023. So for those of you who are new, or maybe even existing clients that are now thinking about following KISS after witnessing what it's done for the other thousands of our clients, what you want to be doing is obviously dollar cost averaging if you're building new positions. Anytime you're building new positions in your portfolio, you're going to want a dollar cost average to give yourself the best chance to lower your cost basis. I employ a systematic strategy for dollar cost averaging whenever KISS sends out a new signal. Recall that I use KISS to manage my entire liquid net worth. What I do whenever KISS sends out a new signal is commit to buying a maximum 15% of my overall account in any one position, in any one particular position in a given week. And what I do during that week is I wait for a big down day. And if there are no big down days, then I'll just buy it on Friday afternoon. That's generally when I trade if there's no opportunity to dollar cost average in a big down day. But if there is a big down day, let's say there's a big down day on here Wednesday in an asset that you want a dollar cost average into, then just hurry up and buy that whole 1,500 basis point allocation. You don't have to wait till Friday. Just take advantage of the market dislocation to lower your cost basis. And so this sort of systematic, week to week dollar cost averaging process allows you to, again, take advantage of any negative price dislocations to lower your cost basis for the various positions. And again, that 15% is not spread out across positions. It's concentrated for each position. So let's say you needed to buy, all three KISS positions. They're not all three invested right now, but let's say we're max invested in KISS like we were for most of 2024 and for the large part of 2023. If you need to buy all three, then you would take 45% of your total portfolio to get 1,500 basis points in SPLG, 1,500 basis points in GLDM, and 1,500 basis points in FBTC. That would be 1 week of dollar cost averaging in KISS. So just be aware of that. Definitely take advantage of any market dislocations. And if there are no market dislocations, I wait till Friday afternoon to transact. That's how I do it. I don't think there's a right answer or wrong answer. I have no idea if there is a right answer. I'm not smart enough to know that. I think, at the end of the day, it's just really a function of how much time and resources do you want to commit to, studying the market and effectively dollar cost averaging. And if you don't have time to do that, then the simplest solution would be to just execute the trade when you get the change in the signal immediately and go on from there. That's exactly how the KISS backtests are organized. They wait a full day to mimic the sort of lag impact for as you might experience as a client. So it's a rolling out a sample backtest. So if there's a signal on a Monday, the KISS backtest, will transact the signal on Tuesday at the close, just to simulate the kind of timing of the real world experience you would have as a client. Let's say you're a client in Australia or a client in London and the market's closed over there and you can't transact. It gives you an opportunity. It kind of aligns the KISS signals with what you would feel as a client if you're an international client. So we want to make sure that there's no look ahead bias as well there. So there's obviously a million ways to skin the cat. There are no right answers, but generally speaking, I think dollar cost averaging when you're building positions is smart. And when you're exiting positions, when KISS sends out sales signals, as clients relearned, going back to March 5th when we sold all of our equities, you want to sell immediately. You can build positions slowly to take advantage of any price dislocations from a dollar cost averaging perspective to lower your cost basis. But when KISS sends out a signal or Dr. Mo pivots you to sell or short an asset, hurry up and do that because the markets tend to take the markets take the window down and the elevator up. Or they take the escalator up and the window down, generally speaking, as we've obviously just witnessed here for the past couple of weeks. So hopefully that was helpful for any new clients who are electing to follow KISS or any existing clients who are waking up to the immense value that KISS provides as a institutional grade risk management overlay at the asset allocation and portfolio construction level for clients. So take advantage of that. And by the way, for those who are new or have not read it yet, please take advantage of our KISS FAQ and our Dr. Mo FAQ if you're going to be following those systems to, manage the asset allocation and portfolio construction in your portfolios. Obviously, these are high-end institutional grade systems. I recommend you understand how the systems work before you start to implement them. Don't just be in a hurry to implement them. Take 10 minutes and read the FAQ so you can get up to speed and actually be able to start to confidently and dispassionately anticipate the signals so that you can confidently and dispassionately and execute on those signals. So hopefully that was helpful. We'll wrap it up there. Darius Dell here presenting our Macro Minute for Wednesday, April 9th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.